Do you own a timeshare, and would you like to learn more about the tax repercussions of selling it? Watch my video to hear more about this potentially taxable event.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
Summer is almost here, and a lot of people are thinking about their summer vacations, like where to go, and more importantly, what will it cost? Timeshares have become a popular option over purchasing a vacation home because this spreads the cost over multiple owners and makes a vacation home more affordable. I recently received an email from one of my clients named Rick, and his question is, if I sell my timeshare, will I have to pay any taxes on the profit? And how do I calculate my profit or loss on the sale? And furthermore, if I do sell at a loss, can I claim that on my taxes? Well, Rick, let me answer your questions in the order you asked them. And under the assumption that the timeshare is strictly used for personal use and does not generate any significant amount of rental income. If the timeshare is sold at a profit, then the profit is taxable for federal income tax purposes. This is considered a gain and should generally be reported on Schedule D within your 1040. The calculation of the gain is basically the difference between your cost and your selling price, net of any selling expenses. Now let me explain what all should be considered in your cost. Your original cost of the timeshare should be added to your closing costs, which include things like title policies and recording fees. In addition, you'll want to add the part of your annual maintenance fees that are apportioned to capital reserves and any special assessments for capital needs which you paid. All of these get added together to arrive at your tax cost amount. When in doubt, contact the Homeowners Association to obtain this information. Once you've arrived at the total tax cost, you'll compare this amount to the sales price less any selling expenses. Selling expenses includes sales commission, listing fees, recording fees, and advertising costs. Now you'll compare your tax costs from step 1 to your sales price less your selling expenses in step 2. And if there's a gain, you'll report that on Schedule D and file that with your tax return. Now here's the bad news. A timeshare that is personal use is considered a personal asset. So when you incur a loss on the sale of a personal asset, the loss is not deductible. And just for your information, you should receive a Form 1099 reporting the sale. So my advice is to go ahead and report that sale on Schedule D, whether you have a gain or a loss, to avoid the IRS sending you a letter inquiring about the details of the sale. The IRS also receives a copy of this 1099 and they'll cross-reference that with your 1040. So if they don't see that on your tax return, they'll send you a letter called a CP 2000. Rick, I hope this was helpful and thank you for your question. If you have tax questions, please feel free to submit them to tina@actservices-inc.com and I'll make it a topic of a future show. For more information on this and other tax topics, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.